Hello and welcome to this first presentation in the workshop Bullets and Banknotes, War Financing Through the 20th Century. In this innovative series of talks, we will be showcasing exciting research in the economic history of conflict financing. Firstly, I'd like to thank the Economic History Society, the Royal Historical Society and Oriel College for their kind support in this enterprise, as well as all of the participants. The format for these talks will be as follows. I will offer a brief introduction to the speaker before we listen to their presentations. At the end, a question will be asked by myself. However, if you have questions for the speakers, please feel free to join us on the 13th of November when a live webinar will be held with the keynote Professor Kenneth Moray of the University of Alberta, as well as our other participants. After the keynote speech, time will be allowed for questions to the other presenters. If you want to send your question over to me to ask on your behalf, I have put my email address in the description of this video. Equally, you can find me on Twitter at davidfalk9. So today, it is my great pleasure to welcome Dr. Norma Cohen. Dr. Cohen was recently awarded her doctorate from Queen Mary, University of London. Prior to her doctoral journey, Dr. Cohen had a very distinguished career in financial journalism, notably with the Financial Times, a publication which I am sure that we are all familiar. Today, she will be talking to us about her work on bondholders and how the British financed their efforts during the Great War from 1914 to 1918. Her work excellently demonstrates the impact that investors had upon the British war effort. If you want to find another piece of Dr. Cohen's work, you will find a link in the description below to a piece that she authored along with colleagues at the Bank of England. So now, without further ado, I will hand over to Dr. Cohen. Over to you, Norma.
Hello.
Hello.
Hello. I'm going to walk you through the material, which is the substance of my thesis. And much has been written about the First World War, but a lot of it concentrates on the military, the political, and the social aspects of war. Very little of it concentrates on finance. And so my contribution to understanding Britain in the First World War is to try to look at the finance. Why does this matter? Why does finance matter? The First World War was effectively a war of attrition. This became obvious to all of the participants within the first few months of engagement. The historian Jonathan Buff compares the war between Britain and Germany as a war between a whale and an elephant. Each was superior in its own surroundings, but neither could defeat the other in their surroundings. Even as the war ground into 1917, the Central Powers looked as though they could still be victorious. They forced Russia into a humiliating and confiscatory surrender in early 1918 with the Treaty of Brest-Litovsk. The outcome of war was by no means certain, even in its final year. The reason the Allies won was because the Central Powers effectively ran out of steam. They could no longer feed, arm, and equip their soldiers. Moreover, domestic opposition to war was rising as starvation plagued Austria-Hungary and the German population. But the Allies, thanks to Britain's capital raising, had the means to outlast the other side. But Britain's path to capital raising was by no means smooth. Britain was certainly the wealthiest country in the world at the outbreak of war in August 1914. But being the world's wealthiest country was no guarantee that it would be able to marshal that capital for the purpose of war. In fact, Britain's first effort to raise capital for war was an abysmal failure. It was aimed at Britain's wealthy investors. It required a minimum investment of £100. Median annual income in Britain was £70 per annum. The effort was a disaster. Less than a third of the intended 350 million was sold. This was kept hidden from the British public for decades. And here you can see an article. This is a 1914 article in the Financial Times saying what a wild success this war loan was. In fact, nothing could have been further from the truth. The FT did write an article about the cover-up many years later with the headline, "A 103-year-old correction." But the failure of this loan would haunt Britain for the entirety of the war. And the lessons it learned were that patriotism alone would not be enough to raise money for war. You needed to do more than that. And so Britain began a battle for capital. There were 3 phases to its battle for capital. The first one, which from the very first day war was declared, was to keep capital, British capital, out of the hands of German institutions and retail investors. So if German investors had shares in your company, you could not pay them dividends. You had to hand the dividends over to a support safety net. Second, by 1915, Britain was importing very heavily commodities and war materials from the United States. This meant it had to make sure that the value of the pound was supported against that of the US dollars. And Britain first offered to buy US dollar denominated securities from British investors and would use these securities, would sell these securities to drive down the dollar and drive up sterling. This had only limited value. Ultimately, Britain confiscated all the dollar-denominated securities, although it did not necessarily sell all of them. But as the war went on, Britain became increasingly desperate, both to support the pound and to obtain capital. So the important thing was that by early 1917, Britain was so desperate for capital that in private meetings between bankers and the Chancellor, Bonar Law threatened the bankers that if they didn't raise a certain amount of money, the banks were told they had to raise 620 million pounds, and the insurance companies were told they had to raise a minimum of 100 million pounds. That if they did not succeed in raising these from retail investors, that Britain was prepared to confiscate the bank's deposits or the insurance company's assets. Britain needed capital. And where did that capital come from? Where did the investors' capital come from? Overwhelmingly, male investors in the ledgers that I examined described themselves, at least in the first round, as gentlemen. What is a gentleman? What does that really mean? When I was able to track these gentlemen in the census records, it turned out most of them were not idle gentlemen living off income from their land. Most of them turned out to actually have a business or a profession. Some of them were able to live on their own means, but the vast majority actually worked. And what you can see from this chart is that the percentage of male retail investors who bought securities and described themselves as gentlemen decreased as a percentage of all retail investors. First, in the very first war loan, which was launched in 1914 and went on sale from 1914 to 1918. In the second war loan, which was launched in 1917 and was on sale into the interwar years. And finally, this is the trading that occurred in the interwar years when that profound changes were happening, not just to Britain's economy, but to its finances and also to its social structure. women investors were increasingly participants in war loan as well. And this wasn't because all the men died, although it was a factor. What happened was women were already investors. Women had been investors in tradable securities from the 18th century. They were increasingly active as investors into the 19th century. But in the late 19th century, fertility began to fall in Britain. And what you had were women who were able to inherit estates that were relatively larger than those of previous generations because they had fewer siblings to share them with. And what you can see is that women as a percent of retail investors went from providers of retail capital went from 23% in the first war loan, a little bit higher in the second war loan, and were a third of all retail holdings by the third war loan in the interwar years. So women were providers of capital. Very few of these women, incidentally, were wage earners. The vast majority were either women who inherited from parents or women who inherited from their husbands. Institutional capital was very important in the First World War. And you can see from these charts, these are the 3 war loan samples that I used, and that retail investors, institutional investors, were very significant in the first war loan. They provided just under half of all capital. By the second war loan, when institutions were facing large commercial demand for capital, they were a much smaller percentage of capital providers at only 15%. But in the after-war years, institutions provided more than a quarter of all of the capital. But another source of capital included in the institutional category are businesses which got rich from war. The other factor that war brought about in Britain was a redistribution of wealth. And I'm going to show you another chart which will show you how people at the lower rungs of income began to benefit and start to turn up. But these are the wealthiest of investors. What war did was first to increasingly concentrate wealth in the hands of those who were already wealthy. In other words, as Thomas Piketty has shown, capital breeds capital returns faster than labor breeds capital returns. And what you can see is that the percentage of retail and of capital provided by retail investors basically, it doesn't show up very well on this chart, but it basically rose by retail investors in lots of £1,000 or more basically rose by 50% between the first war loan sample and the second war loan sample. So if anything, the wealthy, the already wealthy, got wealthier. However, those at the lower edges of wealth also benefited. First, the war created a shortage of labor. The mass conscription, and in fact, even before conscription, the enthusiasm with which Britons joined the military caused factory floors to empty out. This gave labor bargaining power that it had never previously had. Labor union membership more than doubled in the war years. And the war years consisted of tensions, rising tensions between workers and management. But what this meant was workers did have more money to spend. And so what you can see is that by number, the percentage of working class, skilled laborers and tradesmen, and educated professionals, these are people who were in professions that were not historical professions. These are people in relatively new professions, such as accountancy, the actuarial profession, professions that emerged really as a result of needed efficiencies in business brought about by war. And they're only 10% of the first, by number, of retail investors in the first war loan, 12% in the second, but there are a number of these people who are either skilled laborers or educated professionals who did not come from necessarily middle-class families, were 20% of retail investors by the third sample, and they accounted for nearly 14% of capital, up from 4% of capital. So what war did was, yes, it did reinforce wealth at the top end, but it also broadened out the fortunes of some in the lower, middle, and working classes. The other feature was that war made people rich in certain industries. These are industries that had not necessarily been particularly profitable before the war. And they included operators of pubs, they included boot manufacturers, and owners of farms. And what you can see from these three charts is that these industries were not terribly large providers of capital in the early years. During the height of war, they needed capital for themselves, but by the after-war years, industries which had been wildly profitable during war, and these were coal, engineering, and steel, cotton and woolen fabrics, and shipbuilding. Those industries, once war ended, found that demand for their products fell significantly. Capital was no longer able to earn the rates of return in those industries that they had in the war years. As a result, capital was extracted from those industries and recycled into war loan. The war years, the interwar years, 1920 and through 1939, were, certainly to 1932, were characterized by deflation as Britain returned to the gold standard. That meant that the 5% coupon on the war loan issued in 1917 became increasingly valuable. And what you can see is that by the interwar years after 1919, roughly nearly 30% of capital came from industries that had done particularly well out of war. And war loan was particularly attractive to the wealthiest investors, in part because it contained a tax break. Britain had been governed by the principle that tax on securities income is extracted at source. In other words, every dividend, every interest payment had tax taken out before it was paid over to the investor. War loan was different. You were expected to declare it. And because of this, there was widespread tax avoidance amongst the wealthiest investors who were able to avoid taxation. To make a long story short, they sold their securities on the day the dividend was paid to a brokerage firm, who then sold it back to them at a price that included some compensation for the dividend. And this was something which would haunt policymakers all throughout war. To sum up, the capital came first and foremost from Britain's wealthiest investors. But as war altered the shape of Britain's economy and its finances, it became increasingly broad and deep. And over to you.
Okay, wonderful. Well, thanks for that very, very enlightening talk, Norma. And I'm sure many of us will have a lot of questions for you regarding that. Now, My question in particular, why did investors buy war loans? Was it out of patriotism, or was it simply as an investment decision?
I think that there were clearly investors whose purchases you can look at and identify as most likely to have been driven by patriotism. And I'll give you one example, or two examples. One was a woman, one of the single largest investors in war loan, who in December 1914, days after the war loan was unveiled, goes to her bank and buys 20,000 pounds worth of war loan. It's an extraordinary sum of money. The woman, however, was Emily Charlotte Talbot, and she was the heir to the fortune of Talbot, the developer of Port Talbot, the owner of coal mining and steel interests. She developed the port, which would become so crucial for Britain as a shipping port to ship coal, not just to mainland, from Wales to the mainland, but also to France and other allies on the continent. And she buys this war loan, but she does many other things as well. For example, in 1917, 1918, she turns the family estate over to the government as a convalescent home for officers. And she undertakes numerous charitable activities on behalf of military families. Sadly, she doesn't live to see armistice. She died in September 1918. And another example would be Lord Ashton, the Liberal peer, who was known as the King of Linoleum, who inherited linoleum fabrics from his father and developed the industry. And he goes out within days of the launch of the 1914 war loan and buys 100,000 pounds worth. And we look at these individuals who have many other investment opportunities, and the fact that they concentrated so much into war loan tells you that they probably had political or patriotic objectives. But the vast majority of investors do not appear to have been motivated by patriotism. In fact, as I mentioned before, the failure of the first war loan really taught a lesson to Treasury officials that you could not count on patriotism alone. You had to, as the slogan became, make patriotism profitable. And when Britain first decided to try to tap the savings of its working classes and middle classes, that was its slogan. And much of the advertising, the old posters you see on war loan, are aimed at persuading working class people that patriotism could be profitable. However, the vast majority of capital, as my slides show, came from the wealthiest individuals. And for example, there is a family by the surname of Simpson who turn out to be the single largest investors in my entire sample of over 6,000 investors. And in 1927, this is a family who owned coal mines in the north of England, in Northumberland, near Durham, who are listed as mining engineers. But in fact, when you look at the family, you can see that this is a family that not only operated engineering equipment, but actually physically owned mines. And when their father died in 1927, they invested a total of 207,000 pounds in war loan. It's a single largest war loan investor. And you can see that this is a family not at all motivated by patriotism, but motivated by a desire for a safe, secure investment. And you can see that, by the way, not just in the after-war years, but you see it by the participation of pub operators, clothing wholesalers during the war years, when capital would have been needed to expand their businesses, but it was felt that they could probably get a better, safer, risk-adjusted return by investing in war loan. Ultimately, most investors, most capital was probably attracted by a desire for safe returns and not by patriotism.
Okay, very interesting. Well, thank you very much for your talk, Norma. And if everybody could come and join us for the next talk that we will be having in this series on war financing. Thank you very much, everyone, and bye from both of us.